Well, thank you for joining us on our quarterly chart party. A little bit of an expansion of our weekly update.
Yeah, a little longer one because we're going to update you from our market and economic outlook that we did in January.
So be prepared. It's a few more charts than normal, but that's all right. As a reminder, we want to be people's go-to advisor, optimize their wealth, and deliver service with integrity.
And this is part of our service, keeping you updated on the markets.
A couple of housekeeping items, real quick. Save the date, June 16th. We're doing the clay shoot. Doing it for well over a decade now. Raised, almost $52,000. So we're hoping to keep that moving.
Amazing that we've done it that many years, and it's still a great event. Everybody loves it. It's a lot of fun. It's a great time. And last year we did the pork roast thing, didn't we? Last year,
Yeah, we did that.
We did the pig roast.
It was fantastic. And people at the MS Society, happy to do it for them every year. It's always exciting, and we love to be able to contribute to that.
Yeah, hope you guys can make it.
If you have questions, go ahead and make sure to submit them here. As a matter of fact, most of today's presentation is built on questions just like that. So speaking of, first question, what's going on with oil?
Well, there's been a lot going on here in the last few weeks. Just an incredible spike in oil. Oil was under $70 a barrel here 2 months ago, 3 months ago. This Iranian situation drove the price, spiked it up quite a bit. And the questions we've been getting is what's going on with oil and how bad will this hurt the economy? And our answer is not as bad as you think. Now, remember, recording this on Wednesday, and there was a ceasefire announced last night, and oil prices have plummeted. They're not way back to the 70s, they're still much higher, and we're not sure if this is going to hold, and there's going to be another spike. But let's assume that it holds this level or goes higher. We have several charts here we want to show you that will help you feel much more comfortable that this isn't going to be the problem you might expect. And a lot of this has to do with how important oil is to the US economy today versus the past 50 years. This first chart is a very good example. Let's take a closer look at this chart. And this shows you on the bottom gasoline consumption in the US. Last 20 years, it's been down. It's actually down about 4% over 20 years. But look at the top, real GDP. Real GDP is 40% higher than it was 20 years ago, and we're using less gasoline. Why is it? Cars are more efficient. We do have hybrid vehicles, electronic vehicles, but all the cars, all the trucks, all the equipment we use is much more efficient. So this is great news. It's just not as big a deal. Now, next, we're going to show you another slide talking about the price of oil going back the last roughly 20 years as well. In fact, let's put this chart up, and I'm going to focus on the right-hand side of this. This just looks like a wild chart, up and down, back and forth. And that is the problem with oil. It can be all over the place. But for reference, the price when we did this chart a couple days ago, oil was selling at $111 a barrel. Actually, at 114 shortly. If you look back, this is almost 20 years ago, oil hit 145 a barrel. If you adjust that for inflation, in today's dollars, that would be close to $200 or $190. So this is not as bad as it was in 08, which is good news. It's also not as bad as it was in March of 2022 when Russia invaded Ukraine. We had that huge spike to $123. By the way, just since 22, we've had 20+% inflation. So to compare to that, this would have to be $135 in that neighborhood. So we've had bigger spikes and it didn't ruin the economy. And I think 22 is the best example. Even with that spike, the economy grew in the US in 22. It grew in 23, it grew in 24, it grew in 25. In fact, oil was hitting record lows in 2025. And we're going to show you that when we talk about gasoline prices. Even though gasoline prices are up, close to $1 a gallon, we've been able to get through with a growing economy with higher gas prices. And this is a great chart to look at. We're going to take a closer look. In fact, I think we go to just the right side. Now, a little confusing, but I want to focus on the green line first. The green line is 2025, last year. Gas at the pump, less than 3.25, actually went under $3 a gallon. But look at the other lines for 24, 23, and 22. Gas was always higher the last 3 years. So even though it's spiked today, it's up around $4. Now it's going to be down with what happened today. The economy grew nicely. All 3 of those years, we had some years above 3% GDP growth. And this is because our economy is much, much less dependent on energy than it was in the past. So yes, are we going to have higher gas prices? Yeah, I think we're going to be around, $3.50, $4 a gallon for a while. But that did not stop our economic growth in the last 3 years. And it's not going to stop at this time. Is it a little bit of a drag? Yes. But when folks are talking about recession because of this, it's just not in the cards as far as we're concerned. The last chart we're going to look about with oil is our dependence on foreign oil. And this is very interesting. And I grew up in the 70s, so I experienced stagflation. Stagflation was almost exactly caused by the spike in oil. Oil tripled overnight and then went higher for the next 5-6 years. And it crushed our economy. Those prices went up regardless of how fast we were growing. Prices went up and the economy was slow. That kind of huge energy shock took its toll on our economy. Today we have nothing like that. And even if you notice the spike in 07, 08, we didn't have stagflation then either. And this is because we used to have to, according to this graph, import as much as 3% of GDP in petroleum products from overseas. But the chart shows you that's ended. We've become energy independent. We're now negative as you look at the far right-hand side of that graph. That's the other reason we're not concerned. Not only are we using less than we used to, we have all our own oil. So it's not a problem. So we're not changing our outlook for the economy and really not changing it much for our market outlook because of the spike. We feel pretty good about it and we think it's going to be fine. And when you look at the markets trading, the futures markets for a barrel of oil are trading in the 70s in the fall. So investors looking forward believe we're going back down to the 70s or maybe low 80s. This is all good news and this will pass. So with that, we're going to look at the next question everybody's asking us.
Great. So there is a lot of news. So what kind of turmoil should we expect as a result? Well, let's go through some of the basics. Let's look back at history a little bit. This is where we started the year. Are we going to have a recession? And at the beginning of the year, we said there's about a 20% chance, which is, by the way, normal. That's sort of the standard base case. There's always a 20% chance that something comes out of left field that you can't see coming. And we started this year saying the economy was going to be overall strong, to be cautious on the market. But let's look at the economy last year. Q1, things were down. But let's rewind in our minds for a second. That was Liberation Day. We had massive new imports, which is a negative pressure on GDP. And people bought everything they could from overseas because they were expecting price hikes. Well, funny story. In Q2, if you buy a year's worth of products, you don't seem to buy a lot of it in Q2. So we had very record low imports in Q2 and it actually boosted GDP. GDP in Q3 actually was more normalized. And in Q4, we took almost a full percentage point off because of a partial government shutdown that I think most people don't even remember happened. So growth last year overall, without some of these sort of other externalities, was actually very strong. And it looks to be pretty strong this year. You might remember when we started the year, we were looking at flash GDP numbers, which are not official, in the Atlanta Fed, of somewhere north of 5% growth. So the question is, are we going to continue to grow through this? We already talked about how oil probably doesn't have as big of an effect as it has previously. But let's look at things like unemployment. We're hearing talk about unemployment shooting through the roof, right? Well, let's take a quick look at the chart here. If we focus in, we're going to focus on one at a time here. Unemployment right now is about 4.3%. Right? That is 60-year lows. Right? We're near all-time lows. It's a fantastic number. Is it up from the 3.7s we saw a few years ago? Yes, but statistically, right, that's an almost unnatural rate of unemployment. The unemployment rate average is 5.5%. We're not at 6, 7, 8, 9, 10% unemployment like you'd see during a massive recession. We're at 4.3. And you might ask me, well, that's because we haven't seen any job growth. Well, it's pretty amazing if you think about it that the unemployment rate has stayed fairly low, near all-time record lows. And by the way, without a war, near all-time record lows. But the month over month new job changes, that this isn't a new story. If you look at the 3-month average, which is that gray line there, of non-farm payroll gains, this has been shrinking now for 5 years. So what's really happening is we're seeing, less people are leaving the workforce. We're not getting as much new job creation, but our unemployment rate is staying relatively low. That means that things are overall fairly positive, fairly stable over that period of time. So the economy, from that standpoint, looks good. Let's touch base on inflation briefly. Inflation is one of the other big questions because, what's the Fed going to do about inflation? How is inflation going to be affected? This is a chart of headline CPI inflation. So it includes food and energy. By the way, there's a great reason why the Fed doesn't include food and energy when they talk about PCE and CPI, because it's very volatile, as we're experiencing right now. But what's been happening with inflation overall, even with the headline CPI numbers, we said a while back that the dark blue section there, shelter, was headed downward. It continuously has been. We said that, there were some sticky parts of inflation. Dining and recreational services seems to be relatively sticky. Other things, food at home, core goods, auto insurance, all those seem to have come down as well. As a matter of fact, yes, we're at elevated levels from pre-COVID, but we've come down fairly substantially. Oil prices have been higher in 2022, and we had high inflation. See that in that green section there. We don't have that today, but part of what brings inflation is long and sustained expectations. If you ask people last year, and we're right in the first week of April in 2025, if you ask most major economists, they were telling you that inflation this year should have looked more like 4.5 to 6% because of tariffs. That's not what we experienced. That's not what happened. So the expectations can sometimes beget further inflation. We didn't get that. So are we riding at elevated inflation levels? Yes. But are we overly concerned? No. If anything, you got to look at the core numbers. The core numbers are what tell the story. If we go back briefly, we're going to switch to productivity. What's going to drive the economy going forward? So this is a chart of productivity. It's a function. We talk about gross domestic product as how much we produce. We talk about it in terms of how much we consume. In this case, from a production standpoint, we want to look at this. The number of work hours worked times the output per worker is a good way to measure an economy. Where do you get productivity gains or work hour gains? Well, in the 1970s, the best way to add productivity was to add another shift. We had more people, you just added more bodies. Well, today that's not quite the case. And we've talked about, job creation isn't shooting through the roof, but we still have very low unemployment. It means it's hard to find good workers. It means you want those workers to be more efficient. That's the gray bar. Most of our economic growth is coming through productivity gains, meaning people are just more efficient at their job. And funny story, when people are more efficient at their job, you would think employers would say, well, you get to go home early. No, when you get to say you're more efficient and you're making more money than ever per hour, they just want you to work more hours. And most people don't want to do that, so they're trying to drive productivity. That's a function of capital. And lastly, and this is where I'm going to finish up, is expectations. So this is a chart of the S&P 500 of earnings per share. How much do you earn per share available? There's a number of different things on here, and you can see there's been wild swings over the years of the expectations. But in 2025, we started that year saying that we expected growth to be something like 11 to 13%. Just at the end of the last year, it was 11. It turns out, now that we've got the quarterly numbers from last year's earnings reports, it was 13. It was higher than expected. And actually, when we started this year, expectations for growth this year were 15%. Now they're 17. They're actually higher for the next couple of years. What does that indicate? It means that people are relatively positive about the overall economy. So yes, is the oil turmoil a problem in the short run? Yes, but there's a reason why. Long term, right? In December, contracts are still in the 70s. Most people expect this to be a short-lived disruption, but overall not to stampede economic growth. Our expectations are relatively unchanged from the beginning of the year. So for that, I'm going to conclude there. And let's go to the very next question. What does this mean for your market outlook?
So we talked about oil. We talked about what's happening in the economy. We're still confident oil is not going to be an issue. We're confident that we're still going to have a growing economy this year. So have we changed from January? Have we changed our outlook on the market? And the answer is maybe mildly, but not a big change. And we're going to talk about some of the things that are going to help us continue to grow here and probably have an okay market. I'm going to start off with the graph that my son just left off with because earnings drive stock prices. And in January, we showed you a chart. There's a 98% correlation. If earnings go up, stocks go up over time. Well, guess what? With all the change we've had, earnings were up in 24, 25. You can see here, now you see the estimates on the far right side of this graph. Earnings up again, 17, 16, maybe 11%. Now, even if those get pulled back a bit to 15 or 14, that's still relatively good growth. That's not a recession. I think we're going to do fine with that, and that should keep us going. What we were concerned about, and this goes back to January, is when we came into this year, stocks were very, very expensive. And because they were expensive, we said we're going to need that earnings growth if you want the market to stay where it is or go up. And our concern was we might have a flat year for the stock market. Well, we've had a 10% correction now. Good news from that is the next chart. Valuations have come down. And this chart is very important because if you look at just a couple of months ago, the market was trading at 22 times earnings. And looking back 30 plus years, that's a high level. And we said that we're a little concerned. Well, because of the recent correction, and we've gotten earnings coming in from the fourth quarter, we now have a multiple that's under 20 times. Is that great? No, but it's much better, and it makes us feel better about making money over the next 5 years. And we have a chart that shows statistically how much money you make when you buy markets at different valuations. And let me explain this as we focus in. Look carefully at the bottom part of the graph, the x-axis. You've got 18 to 26 times. That's what you're paying for the market. See, today it points out April 2nd, we're paying just under 20 times. That's the red diamond you see in there. On the y-axis, it shows how much your annualized return was if you bought at the certain levels. You notice that if you get past 23 times, look at the bottom there, all those diamonds are negative over 5 years. You can pay too much for stocks even though the earnings are growing. In this case now, we have a good probability of making 4 or 5% a year annualized over the next 5 years. And that's because earnings have grown and the valuations and prices have come in. So that's a positive. And it reinforces what we said this year. It could be a soft year for the market. Right now, the market is negative. And we thought this year if it was 0 to 8% or 7%, we'd be happy. Well, we got a chance of coming back into the positive range. The other concern we had back in January was an overconcentration of the Mag 7 or the large names. And the air is coming out of that bubble, which is a good thing for the market. And you notice on the top part of this graph, look at 26 year to date. Look at the green line there. Mag 7 is down 10%, much more than the overall market. That's a good thing because that part of the market was kind of a bubble-ish thing, and we wanted to bring that back down. Overall, if you look at the broad S&P, the equal weighted, it's flat for the year. The S&P itself is down about 4%. This is not bad. We're comfortable that that part of the equation is working in our favor going forward. So good news on that one because it was one of our concerns. With that, again, we're not changing a lot what we're looking for. Again, a flat to +5 or +7% year is still in the cards in our opinion. We don't see a lot of reason with a growing economy and growing earnings to have a negative year this year. Now, that said, this chart goes back 45 years and shows you what the average entry year, during the year corrections happen. The gray bars are how we ended the year. The red dots are the intra-year corrections. We're down 9% so far this year. Average is -14. This is an average correction. We just got through with the first quarter. We had our correction. This could be it. We could work our way back to positive as the year goes on. Now, something else could come up and disrupt us. But when I get asked, hey, are you worried about this recent correction? No, it's barely an average correction. And we're fine with that. Once the oil situation stabilizes, you're going to have oil prices come down. We could have a nice growing economy next year for the U.S. and the world that leads us to believe we're not going to have bad returns this year in the stock market. So overall, we're still feeling very positive. We haven't been happy like the rest of you. This has been very frustrating and nerve-wracking to watch what goes on. But otherwise, we feel pretty good. And we'll finish it up with that.
Well, thanks everybody for joining us, and hopefully if there are any follow-up questions, you can send them in, and we'll see everybody soon, and probably not till tax day.
Which is our least favorite day. But with that, we'll talk to you again soon. Thanks.